Tired of watching your money sit there and do nothing in a savings account? Well, let us tell you about a better way to grow your wealth. Today, we are going to talk about dividends. So ditch the piggy bank and unlock a new way to grow your wealth. It's time to put your money to work for you. In this video, we'll break down how dividends work, how you can potentially use them to generate passive income and build wealth over time, and answer some key questions you might have. So whether you're a seasoned investor or just starting out, stick around. This video is for you. Let's meet David, a regular investor just like many of us. David just received a notification on his brokerage account. Let's take a closer look. It says, dividend payment. Interesting, but what exactly is a dividend? Well, to understand that, we need to peek inside a company's finances. Imagine a company makes a profit, like a delicious pie. This profit is the money left over after they cover all their expenses. Now, the company has some decisions to make. They might choose to reinvest some of the profits back into the business for future growth. They might also use some to pay off any debts. But here's the cool part. They can also share a portion of those profits with the people who own a piece of the company, the shareholders. And that's exactly what a dividend is. It's a portion of the company's profit that's paid out to shareholders like David. So whenever David sees a notification like this, it means he's getting a little piece of the pie, a little cash reward for owning shares in that company. Pretty cool, right? Now let's explore how dividends work in more detail, including which companies pay them and some important dates to keep in mind. Not all companies hand out dividends like candy. It depends on a few factors. Younger companies in their growth phase might choose to reinvest most of their profits back into the business to fuel expansion. This helps them grow faster and potentially become more profitable in the future. On the other hand, more mature companies, especially those in stable industries, might have less need to reinvest everything. They might have a more consistent track record of profitability, making them more likely to share some of that success with shareholders through dividends. Think about companies like utilities or consumer staples. They often have established customer bases and predictable cash flows. This makes them more likely to distribute a portion of their profits as dividends. So how do we know if a company pays a dividend? It will show in the summary information when you look up a ticker symbol on most websites that provide stock quotes. You can see the annualized dividend amount and the dividend yield, both shown here. Now, you found a company that pays a dividend, so when do you actually get paid? Here are specific dates to be aware of. Let's take a look at our dividend calendar. First, we have the declaration date. This is when the company officially announces that they're going to pay a dividend. They'll also specify the amount and another important date, the record date. The record date is like a snapshot. Only shareholders who own shares on this specific date will be eligible to receive the dividend. There's another date to keep in mind, though, the ex-dividend date. This falls one business day before the record date. Here's the catch. The share price typically adjusts downward by the amount of the dividend on the ex-dividend date. Think of it like buying a stock with a coupon attached. If you buy before the ex-dividend date, you get the coupon, the dividend. But if you buy after, you miss out on that specific payout. Finally, we have the payment date. This is the exciting day when the dividend is actually distributed to shareholders' accounts. So, how do these dividend announcements affect the share price? It can be a bit of a dance. Investors seeking immediate income might be drawn to a stock before the ex-dividend date, knowing they'll receive the upcoming payout. This potential buying pressure could push the share price up in the lead-up to that date. But remember the ex-dividend date? Here's where that price adjustment comes in. Since new shareholders buying after that date won't receive the upcoming dividend, the share price typically reflects this by dropping by the amount of the dividend. It's important to remember that dividends are a return on your investment, not necessarily a gain in the share price itself. You're essentially getting a portion of the company's profits delivered to you in cash. Think of it like this. Imagine you buy a stock for $100. The company announces a $2 dividend, and the share price drops to $98 on the ex-dividend date. You still own the same stock, but now you also have $2 in cash. The overall value of your investment, stock plus cash, remains $100. So while dividend announcements can influence the share price in the short term, the long-term value of the stock depends on the company's overall performance and growth potential. So far, we've talked about dividends from individual stocks. But what about mutual funds and ETFs? Can you get dividends from those too? Absolutely. Both mutual funds and ETFs can be a source of dividend income. However, there's a slight difference in how they distribute those payouts. Let's take a look at mutual funds first. A mutual fund is like a basket holding a variety of stocks. The fund manager actively manages those holdings, and any dividends received from the individual stocks within the fund get pooled together. Based on the overall performance of the fund's portfolio, the fund manager then determines how much of that pooled dividend amount will be distributed to shareholders. Now, ETFs, or exchange-traded funds, are a bit different. They are similar to mutual funds in that they hold a basket of underlying assets. However, ETFs are generally passively managed, and many track a specific index. Because of this passive management style, ETFs generally distribute most of the dividends they receive from the underlying stocks directly to a shareholder, as expense ratios for ETFs are typically less than mutual funds. So, which one is better for dividends? It depends on your investment goals. Mutual funds offer diversification through their variety of holdings, which can be a good thing. However, ETFs might be more tax efficient because they typically generate fewer capital gains throughout the year. Remember, this is just a brief overview. There's a lot more to learn about both mutual funds and ETFs, but hopefully, this gives you a basic understanding of how dividends work within these investment vehicles. So far, we've explored the basics of dividends, but before you jump in and chase those high dividend stocks, let's talk about some additional factors to consider. First, there's something called the dividend yield. This is a fancy way of saying what percentage of the share price is paid out as a dividend each year. It might seem tempting to go for stocks with the highest yield, but hold on. A very high yield could be a red flag. It might signal that the company is struggling to grow its profits and needs to pay out a larger portion just to keep investors happy. Instead, look for companies with a consistent dividend history. A track record of reliable payouts over time is a good sign of a financially stable company. Even better, consider the dividend growth rate. This tells you if the company is actually increasing the amount of the dividend payout over time. This shows a commitment to sharing their successes with shareholders and can be a sign of a healthy, growing business. Remember, dividends are just one piece of the puzzle. Before investing in any company solely for its dividend, do your research. Look at the company's overall financial health, its future growth prospects, and its management team. Think about the company's long-term prospects, not just the next dividend payout. A strong company with a bright future is likely to be a better investment than one simply offering a high dividend today. Now, even though dividends can be a great way to generate passive income, there are always some risks involved. For example, a company might be forced to cut its dividend in the future. This could happen due to various reasons, like an economic downturn or a decline in the company's profitability. Remember, dividends are not guaranteed, so it's important to be aware of these potential risks and to diversify your investments to avoid being overly reliant on any single company's payouts. So, there you have it, a crash course on dividends. Hopefully, this equips you with a better understanding of how they work and the factors to consider when evaluating dividend-paying stocks. But remember, this is just the beginning. Before making any investment decisions, do your own research, consider your financial goals, and consult with a financial advisor if needed. For more investing tips and tricks, be sure to subscribe to this channel and leave a comment below with any questions you might have. I'd love to hear from you.